Imagine waking up every morning knowing your investments pay for everything, your rent, your food, your vacations, without ever working again. How much do you actually need to save to make this a reality? 500k, a million, or more? In this video, I'll show you the exact formula to calculate your freedom number, the best dividend-paying investments, and the fastest way to reach your financial independence, so you can start living off passive income sooner than you think. And trust me, some people are doing this with way less money than you'd expect. Let's break it down. Stock prices go up and down. The market crashes, recovers, and crashes again. But what if you could ignore all of that because your investments kept paying you no matter what? That's the power of dividends. Companies share their profits with investors like you, meaning you get paid just for holding the right stocks or ETFs. Dividends are passive and reasonably predictable, allowing you to earn money without lifting a finger. Second, if you invest in good quality dividend-paying companies, they'll provide cash flow for life. You can either reinvest and grow it or live off it. You have a lot of choices. And third, you don't have to time the market or sell assets to generate an income. Sounds great, right? But how much do you actually need to make this work? The first thing you need to do is assess what your lifestyle would look like if you were to live exclusively off dividends. This would be different for everybody, as we all have different expectations. If you're at an advanced stage of life, you might want to remain in a city to be close to family or healthcare providers. If you are younger, perhaps moving overseas to a cheaper country might be an option. In places like Bali and Chiang Mai, digital nomads building online and passive sources of income can get by fairly cheaply. Others might own their house outright, so major housing costs like rent and mortgage aren't a factor. So really, you want to scan through all of these factors to create a realistic budget of the minimum amount you'd need to comfortably live. And this will probably look different to your expenses today. For example, if I was to do this, I'd be looking at a country like Malaysia with much lower living costs. It would be about $1,000 for housing. Each meal would be under $10. Public transportation is cheap and reliable, and utilities and fuel are heavily subsidized. This, of course, is a much different set of annual expenses than what I'd experience if I was in New Zealand or Australia. So you want to assess this looking forwards, taking into consideration how things would change if you were living off dividends, and perhaps how your life might evolve depending on your stage of life. So with your estimated annual expenses number, divide that by a reasonable average dividend yield. Here in Australia and New Zealand, getting a 4 to 5% dividend yield is reasonably easy, and we'll talk through some of those options shortly. So that calculation gives us a required dividend portfolio size. Let's run a couple examples. In my Malaysia example, I'd estimate it would cost about $40,000 a year to live comfortably. If I invested in a portfolio generating a 5% dividend yield, I'd need to have invested about $800,000 to achieve my desired income. If, on the other hand, I was in Sydney, perhaps I'd need $80,000 a year to live, in which case I'd need a portfolio worth $1.6 million to be financially free. If you have access to a government pension or other fixed income, you can subtract that off of your annual expenses, which will bring down your required portfolio. For example, if you have a pension of $30,000 a year, you'd only need a portfolio of $200,000 to cover $40,000 in annual expenses. But you might still be there thinking, wow, that's a lot of money. How can I save so much? Like any worthwhile goal, it's going to require commitment. First, consider what you have today. Let's say you have $50,000 tucked away. That's a great start. From there, think about how much you can save each week. If you are currently in paid employment, perhaps $200 a week is a realistic amount. Plugging those numbers into a compounding calculator, we'd have $310,000 after 10 years. After 20 years, this grows to over $1 million. Here we're using an average return of 10% a year, which is fairly average when we look at the long-term average of the S&P 500. So it's certainly possible, and you might have your own circumstances that make this process faster. You might have a gain in the value of your house, win the lottery, receive an inheritance, or even find a wealthy partner to make this entire video irrelevant anyway. The point is, it's certainly possible. There is another popular approach to living off stocks called the 4% rule. The theory says that 4% is a safe annual withdrawal amount, as the remaining 96% of your portfolio should on average replenish or even continue to grow your portfolio. Many people have run the numbers over the years and arrived at this number. The key difference between the 4% rule and just living off the dividends is that you don't need to sell assets to live. You just need to live off the cash flow it provides. This allows your portfolio to continue growing, selling nothing, so it is truly passive, and you aren't forced to sell your portfolio during a market downturn like a 4%er would. Another consideration I haven't covered yet is inflation. In the past few years, it has been a real issue for many households, and especially those on fixed incomes. In our earlier calculation, we estimated our annual expenses using today's costs. Over time, we'd expect inflation to increase these, of course. If you have picked good quality dividend stocks, I'll tell you why it's less of a worry. A good quality business will often grow year after year. They can expand into new markets, new product lines, and even find new efficiencies in their processes to increase revenue and reduce costs. That, of course, is great for profitability. Good quality businesses may also have pricing power that allows them to increase prices faster than the broader inflation levels. Disney, for example, is a one-of-a-kind product, and here you can see their ticket prices increasing at least 4 times as fast as rent, wages, and petrol. By growing operations and profit levels, dividend stocks will have more money to pass to shareholders each year. So while our annual expenses might continue to grow due to inflation, our dividend yield on a cost basis also tends to grow as we have already locked in our stock price at the time of purchase. The key is to find good quality businesses with market commanding positions and a strong culture of paying dividends. So what investments should be in your dividend portfolio? It really comes down to personal preference. The first place to look is individual stocks. Many companies in Australia and New Zealand pay healthy dividends and have been doing it for some time. Make sure to check out some of my other videos as I break down some of the highest yielding and most reliable dividend payers in Australia. The second place you could look are exchange-traded funds. Major ETF providers like Vanguard and BetterShares have a suite of high dividend options. Vanguard's Australian Shares High Yield Fund is a popular option, as are BetterShares' various dividend yield maximizer funds. The third option you have are low-cost index funds, which are similar to exchange-traded funds, but you can purchase units directly as opposed to through an index. If you're mix and matching, just make sure to pay attention to the top holdings in the funds. You might be double dipping, as the fund might invest in the same stocks you're already investing in directly. Also, make sure to pay attention to the fees on the funds, as these obviously dig into your dividend income. To add to that as well, if you're based in Australia, pay attention to the franking credits, and in New Zealand, the imputation credits. These offset the tax you'll be required to pay on your dividend payments, which again reduce the net amount you receive. Overseas investments will often carry no franking credits, so you may have additional tax implications to consider with these investments. Diversifying your exposure is important as well, as a given company or industry might have a rough year, resulting in less dividend income getting paid out. For example, in New Zealand during the pandemic, the Reserve Bank of New Zealand required banks to halt all dividend payments, which would have been catastrophic for an investor relying solely on the industry for an income. So spread your investments across companies, industries, and even geographies. Here is a chart showing the markets that have strong average dividend yields. Even though America is near the bottom, they have a few blue chip stocks like Verizon, AT&T, Altria, and Chevron that pay a comparable yield to Australia. Just keep in mind the tax implications of investing abroad, as we spoke about earlier. While you're building out your nest egg, you can reinvest dividends either directly or through a dividend reinvestment plan if your investments offer this as an option. This builds your pot of funds faster, offsetting the amount you personally need to invest from outside sources of income, like a job. If you're serious about tracking your portfolio, ShareSite is an incredible tool used by over 400,000 investors all over the world. Integrating with over 200 brokers, it automatically tracks your portfolio, dividends, and capital gains, giving you a complete picture of your true returns. Plus, you can try it for free, and if you sign up for an annual plan, you'll get 4 months free with my code down below in the pinned comments. If you want to see more dividend content, make sure to check these videos out somewhere over here. Also, make sure to subscribe down below to see more content just like this. Thanks for watching, and I look forward to catching you on the next one. Cheers.